Hi, this is the Group 14 Economics 2050 presentation. On April 2nd, in a move reminiscent of previous presidential-led economic turning points, American President Donald Trump introduced a sweeping reciprocal tariff policy on U.S. trading partners. This policy implemented a baseline 10% tariff on imports, with higher tariffs imposed for countries with larger trade imbalances. In response to the ensuing financial turbulence from Trump's protectionist policies, a 90-day pause on reciprocal tariffs bar China was implemented. However, recently China and the US have reached a cease in the tariff war, with both parties lowering tariffs. Trump's tariff strategy is inextricably linked to the seigniorage privilege of the USD. He is transforming the unique position of the US dollar as the world's primary reserve currency into a revenue stream capable of addressing America's national debt that has accumulated to over $36 trillion. The questions raised by these policies, which will be discussed during this video, is whether Trump, like President Nixon in 1971, will be able to structurally shift the global economic order to ultimately consolidate American power and prosperity. In 1971, President Nixon moved away from the Bretton Woods system, where global currencies were pegged to the US dollar and the US dollar to gold, towards transforming the dollar into a pure fiat currency. This move allowed the US to run higher deficits without losing international confidence, as countries now held the US dollar in reserves. Just as Nixon worked to monetize America's monetary dominance, Trump seeks to monetize its trade centrality. Trump's tariff policies gain confidence from the US dollar's hegemonic status and the inability for foreign economies to easily retaliate without harming themselves. However, just as Nixon's decision caused unintended consequences of substantial debt, Trump's approach risks weakening the US dollar system he is working to exploit. Sarah is now going to further discuss the rationale and goal of Trump's reciprocal tariffs. Thank you.
When examining the economic implications of reciprocal tariffs on global financial markets, focusing on market reactions following the tariff announcements early on in 2025, we look at April 2nd. On that day, news of escalating trade tensions reverberated across global stock exchanges. Major indices experienced significant losses. The S&P 500 futures fell by 3.9%, the Nasdaq 100 by 4.7%, and the Dow Jones Industrial Average declined by 2.7%, underscoring the tech sector's vulnerability due to its reliance on Chinese manufacturing and broad-based investor concern. International markets were equally affected. Japan's Nikkei 225 fell by as much as 4.6% early on, and Germany's DAX declined by 1.1% amid fears of a rising production costs and supply chain disruptions. Although the Hang Seng Index did not initially fall, it later plummeted by 13.2% on April 7th, evidence of delayed but severe market corrections. These sharp declines highlight how interconnected global economies have become and how sensitive investor sentiment is to policy uncertainty. Below, you can see a graph of the S&P 500's sharp decline on April 2nd. While many sectors suffered, domestic producers such as steel and aluminum firms benefited from reduced foreign competition. Conversely, industries reliant on international supply chains, including manufacturing and technology, faced margin compression and declining investor confidence. The short-term effects were many. The markets displayed heightened volatility. News of potential trade negotiations triggered relief rallies, echoing patterns such as the 2019 China Phase 1 deal, which led to record highs in the S&P 500 back in President Trump's first term. This sensitivity underscores the influence of political rhetoric on market psychology. As risk aversion increased, investors shifted capital into safe haven assets like US Treasury bonds and gold, signaling a retreat from equity exposure during periods of uncertainty. To conclude, these tariff-driven shocks reveal both short-term volatility and long-term strategic shift in investment behavior, emphasizing the need for coherent trade policy frameworks that foster stability and predictability.
Thanks, Edward. A key concept in this analysis is the term seigniorage. This is the profit which a government receives through issuing currency, which pretty much is the difference between the cost of issuing currency versus what the government gets for it. With the US dollar being the world's main reserve currency, the US holds an outsized seigniorage privilege. To maintain currency reserves and conduct international trade, foreign governments, central banks, and corporations hold trillions of dollars in the USD. With this creating a unique demand for US dollars, it allows the US government to borrow with lower interest rates and also run bigger fiscal deficits than most other countries without the same immediate consequences. Trump's new tariff policy was implemented with this concept's strength in mind, taking a protectionist approach after decades of pushing free trade, seeing tariffs as a revenue source, not just as a tool to protect American jobs. Through taxing imports, especially from the countries who have trade surpluses like China, it allows the US to generate money to reduce their national debt while also encouraging domestic companies to bring their production local. The issue is that the US has built their global influence and pull partly through promoting open trade. Therefore, shifting to protectionism is a gamble, risking alienating their allies, disrupting supply chains, and even threatening the strength and trust in the dollar itself. Trump's goals during the 90-day pause on tariffs was to use the threat of a tariff as leverage to negotiate and put pressure on better deals with countries, excluding China. However, if the policy is fully reinstated, it risks retaliation, price hikes, and there are even chances of economic slowdown due to potential reduced overall economic output. Tariffs alone can't fully solve national debt, as there is not enough revenue to cover what is owed. Trade wars can also shrink the economy and reduce overall tax revenues, which has the potential to make the debt problem harder rather than solve it. Long term risks should be considered due to the pull that the US has on the rest of the world's economies. This kind of policy could risk pushing countries away from the US dollar, especially if they see it being used as a weapon in trade disputes, hence the introduction of BRICS. And now we've got Timon talking about the impact of the reciprocal tariffs on global markets.
Implications of the 90-day pause and what happens next. Slide 1. The 90-day pause and what it means. The 90-day pause on tariffs excluding China offers global markets temporary relief, gives companies time to stabilize supply chains, avoid price hikes, and plan ahead. Inflationary pressures also cool down slightly as import costs temporarily stop rising. Let's look at the graph titled Global Import Volume over time. You notice that trade volume shows a modest uptick during the pause. This reflects how importers quickly take advantage of the tariff break to move goods and restock. But what's more telling is the projected decline post-pause. This suggests that if tariffs return, companies expect disruptions to resume, likely reducing trade flows once again. So while this brief pause boosts short-term trade activity, it also highlights just how sensitive global markets are to tariff policy shifts. Slide 2. Risks during the pause. While the pause is helpful, it doesn't eliminate the uncertainty that the uncertainty. The biggest risk here is hesitation. Businesses don't want to invest or expand without knowing what happens in 90 days. The investment confidence index graph shows exactly that, but before the pause, confidence was already falling. During the pause, instead of improving, it drops further. Why? Because a temporary pause doesn't solve the bigger problem, it just delays it. The future outlook bar is the lowest, showing growing pessimism. This suggests that many firms are preparing for tariffs to return rather than a favorable resolution. The pause helps avoid immediate damage, but it doesn't inspire long-term confidence. In fact, it can deepen the uncertainty that slows economic growth. What happens after long-term impacts? Once the 90 days are up, all eyes will be on what comes next. If tariffs return, companies will face rising costs, and so will consumers. The tariff impact on consumer prices chart shows projected prices increase in essential sectors: 12% in electronics, 15% in machinery, and 8% in apparel. These aren't small bumps, these are changes that can ripple through the economy. Higher prices mean tighter household budgets, lower consumer spending, and slower overall growth. On a global scale, tariff reinstatement could spark retaliation from other nations, reigniting trade tensions and undermining economic stability. So while the 90-day pause buys time, if it is followed by tariff escalation, we could be looking at renewed volatility in both trade and markets, unless a lasting policy shift takes its place. Our next group member, Stefan, will explore the risks and predictions of Trump's tariff policies and will determine if they can actually work.
Thank you, Han, for that. As you said, I'll be talking about Trump's tariff policies. If they will. Thank you, Han, for that. As you said, I'll be talking about if Trump tariff policies will work, as well as the risk and overall predictions of them. Okay, perfect. Let's begin. By analyzing the potential success of Trump's tariffs. For this strategy to work, the tariffs must generate substantial revenue. This is key, directly reducing the overall national US debt. This requires significant import reduction and a robust domestic production growth. However, success is contingent on maintaining a positive trade balance without triggering severe retaliation from other countries. However, this strategy is fraught with risk. Retaliatory tariffs can spiral into prolonged trade wars, destabilizing the overall global markets. This can trigger investor panic, plummet stock markets, and even push the US towards recession, increasing rather than reducing the national debt. This has already been seen recently in how quickly the markets have responded to Trump's tariff policies. A critical long-term risk is the potential loss of the US dollar status as the world's reserve currency. If tariffs disrupt the global trade excessively, other nations might pivot to alternative currencies, eroding the US signage and financial influence. Moreover, the following tariff announcements, global markets experience significant volatility, as already said before. Major indices like the Dow Jones and the Nikkei plunged due to investor uncertainty. These tariffs also disrupted global supply chains, affecting multinational companies and trade-dependent economies worldwide. In summary, our analysis has shown that Trump tariff policy is a high stakes strategy that draws on the USD's global dominance, echoing Nixon's historic move away from the Bretton Woods. While these tariffs could generate revenue and reduce national debt, they also carry significant risks, including trade wars, market instability, and potential decline in the USD's global role. The outcome remains uncertain, making this a pivotal time for the US economic policy. And below, we've got our reference lists. Thank you very much.